Okay, we're going to analyze transactions now, and we're going to use this debit and credit system. To begin with, issued stock to investors, and I received $15,000 in cash. This is the company, sells shares, and receives cash. So cash goes up, so it's debit, cash, and we always do the debits first, and then we do the credits. So credit, in this case, common stock. Okay? Now do the debits first and then the credits. Purchased a car for $10,000 cash. So debit, vehicle, and we would credit cash because we paid cash for it. Cash goes down, and then decrease in an asset is a credit. Purchase supplies, but I did it on account. So the asset supplies goes up, so it's debit supplies. And my liabilities go up. And an increase in liabilities is a credit, so I credit accounts payable. I billed for services performed. Every time I perform services, I earn revenue. It's a credit to revenue. The debit is either cash, I get cash, or I get an IOU, which we call accounts receivable. In this case, I was billed. So therefore, I got an accounts receivable. Debit accounts receivable. They owe me. Credit revenue, because I have earned it. Every time you earn revenue, it's credit. Paid $200 cash for advertising. Well, this is an expense, and expenses are always debited. So advertising expense, debit, and credit cash, because I paid for it. If I didn't pay, it would be accounts payable. Received $1,100 from customers I billed up in here. Okay, so they're reducing their accounts receivable, and I receive cash. So the debit is cash, and the credit is accounts receivable. Accounts receivable decreases. I paid a creditor $300 on account. So I have an account with this creditor, and I reduced my amount that I owe him. So it's debit to accounts payable. A reduction in a liability is a debit, and a credit to cash. And lastly, I paid dividends. I give the shareholders back some of the money I've earned, and that is a decrease in shareholders' equity, so dividends are debited. Debit dividends, and credit cash. There we have it for Ace at the Place. We'll move on to the next one. Okay, Wilson Real Estate. October 1st, we've seen this entry before, or this transaction. Stockholders invested $30,000 in the company. So the company has the cash, so it's debit cash, $30,000, and credit common stock, common shares. Now, on the second, I hire an administrative assistant at annual salary of $36,000. Well, we are recording business transactions here, and there has not been an exchange. I simply hired a person. So this is not a transaction. I would not record it. So we move on to 3. I buy office furniture for $3,800 on account. Now this is a transaction. There has been an exchange. And the exchange is such that I debit office furniture, or just say furniture. I have the furniture, and I owe that company, so it's credit accounts payable. Now I'm a real estate company. On October 6th, I sell a house, and I earn commission, and I have not been paid that commission yet. But nevertheless, I've earned revenue. So I debit accounts receivable because I will get that money later. And I credit revenue. You always credit revenue when you perform the service. Whether you got the money or not does not matter. We'll talk about that later. October 10th, I received cash again as commission. This time I received cash. So debit, cash, and I earned revenue. Credit, revenue. On the 27th, I pay $700 on account for the office furniture. So if I paid that, then my accounts payable goes down, so it's debit accounts payable. And my cash also goes down, credit, cash. Then I pay the administrative assistant $3,000, so they perform services and I owe them. Now this is a debit to the expense, and this is called salaries. So expenses are always debited, and I either pay them cash or I owe them accounts payable. So the credit here is cash, I paid them. And that completes the second one. One more. Now we're looking at transactions for ABC Corporation. May 4th, I paid $700 due to suppliers previously purchased on account. So I'm paying down my account. So it's debit, accounts payable. I'm paying it down, my liability, and it's a credit to cash. My cash also goes down. On May 7th, I performed services, so it's a credit to revenue. Now, did I get cash? No. It's on account. So it's debit, accounts receivable, and credit, revenue. Every time I perform a service. I purchase supplies on account. My supplies goes up, debit supplies. Beginning to see how these transactions repeat themselves. And my liabilities go up, credit, accounts payable. Purchased equipment for $1,000 in cash. Equipment goes up, debit equipment. It's an asset. And cash goes down, credit, cash. 2 is an asset and a decrease in assets, a credit. Paid the employees $530. Okay, again, it's an expense. Debit, salaries, expense. 530. And credit, cash. Credit, cash. I received a bill for equipment repairs. So this was service performed for me. So that's an expense. So my expense is always debited. Debit, repairs, expense. Now, with every expense, I either pay it or I've been billed. In this case, I've been billed. So the credit is I owe the person, so it's a credit to accounts payable. And lastly, paid $12,000 for $1,200 for 12 months of insurance policy, but begins June 1st. Now this, I purchase insurance to cover me for a year. I do that on May 29th. In essence, I've bought an asset that will protect me for a year. So we call that asset prepaid insurance. So we debit prepaid insurance. Okay, and we credit cash. So you see now, you practice these transactions. The debit and credit system is a very simple way of doing things. But you need to practice. What increases on the asset side, it's a debit. On the liability and owner's equity side, it's a credit. The decreases are the opposite. So, again, I'll give you more problems for you to practice.